Welcome to Westminster College Center for Financial Wellness. This lesson is on product-based transactions. We will continue using the balance sheet equation to analyze. In this lesson, we'll be concentrating on transactions unique to product-based businesses. All the previous lessons have focused on a company that provided service as its method of generating wealth. A company could provide value to its customers by mowing lawns or installing computers or providing accounting services or pedicures, etc. These companies all use time and talent to generate wealth. Another means of generating wealth is by selling a product to customers. Companies like Walmart and Best Buy sell consumer goods to their customers. Instead of generating wealth by using time and expertise, these companies buy goods like food and electronics from vendors and then sell these goods to their customers, hopefully at a profit. Product-based companies have some unique accounts and transactions that will be explained in this lesson. Okay, note that a business could additionally manufacture rather than purchase the goods that it sells to its customers. The accounting used for the internal management purposes of manufacturing is called managerial accounting. We will not be focusing on that. Instead, we are continuing learning and using financial accounting. We're concentrating on a business that buys goods that they then sell. All right, similar to previous lessons, you will be actively participating in analyzing some business transactions. Please access, open, and save the CFW Product-Based Transactions Exercises workbook. We will follow the same analysis methodology, first looking at the impact on the balance sheet accounts, and then determining if there is an impact on the income statement accounts. So pause your video now and access and review that workbook. Okay, inventory. This is a unique asset that product-based companies will have on its balance sheet. These are the goods that Walmart or Best Buy would sell. Inventory is the one asset that a company will purchase with the sole purpose of reselling it. Additionally, product-based businesses will be involved in two types of transactions related to inventory: when the business buys it from the vendor and when the business sells it to the customer. Okay, a business buys inventory at cost, and the business later sells the inventory at price. For example, I could buy a pair of shoes for $15 and then turn around and sell them on eBay for $95. $15 was the cost, the $95 is the price. We will look at both the transactions for buying and selling inventory in this lesson. All right, our first transaction. TLC purchased with cash $900 worth of trees to be sold to customers. So it looks like TLC is now not only providing services of mowing lawns, but maybe doing some sales of inventory. Okay, so hopefully you can recognize from our prior lessons that this is an asset exchange transaction. I'm going to bring up my balance sheet equation. Okay, on the balance sheet equation, the customer the TLC purchased this with cash, and they're receiving a new asset. So let's look and see what we have. So we've got our cash. We know that we're decreasing that. So I'm going to go ahead and put a negative 900 here. And the asset that we're receiving is specifically called, we just talked about it, inventory. So I'm going to go ahead and increase that inventory account. All right, looking at my balance sheet equation, my balance sheet balances, there's a 0 change to net assets, and there's a 0, nothing happened over in the claims. So we're done with our balance sheet. Okay, TLC didn't generate or consume wealth here, did they? They just swapped types of assets. So there's no involvement on the income statement for this transaction. Okay, now note again that this is the cost of the inventory to TLC. Okay, an obvious next transaction would be that TLC would sell some or all the inventory. All right. But before we do that, we need to talk about a couple more new accounts. Sales and cost of goods sold. Okay, both of these are income statement accounts, and both are impacted when a business sells inventory to a customer. Sales is typically the revenue account name used in inventory sales. Not always, sometimes they just call it revenue, but a lot of times you'll see sales. So sales is just a revenue account. Okay, the price of the inventory charged to the customer will be recorded in this account. Okay, cost of goods sold is an expense account used in inventory sales. The cost of inventory sold to the customer will be recorded in this account. As we will see in analyzing the next transaction, the difference between the sales price and cost is the gross profit that the company will make. So let's go ahead and analyze this. Okay, TLC sold trees costing $200 to a customer for $500 cash. Okay, this is looks like a simple transaction, but it's busy. The reason being, there are actually 2 accounting transactions within this one business transaction. TLC made a sell, and TLC is giving up inventory. We're going to analyze these 2 accounting transactions one at a time. All right, I'll bring up my balance sheet equation. All right, so the sales portion of this, TLC is generating wealth, right? They're selling inventory. That's what they do for a business. So we know that our retained earnings account will increase. Okay, related, their customer gave them cash. So we know that our asset cash is going to be increased. Let's see, they sold it for the $500. Did you recognize that it's $500 cash they received? So let's go and put the cash in first. That's my increase. Well, that's an increase that's earning wealth of $500 also, internally generated because they earned it, right? So my retained earnings will go up. Okay, both assets and claims increased by the 500, so my balance sheet equation balances. All right, retained earnings changed. So we analyzed to see if this was due to a wealth generating operations type activity, and it was. TLC is earning this wealth by selling the inventory. So sales revenue, notice I've got sales here included in addition to the revenue now, will increase by the 500. If revenue goes up, then net income goes up. The net income and the retained earnings changes are the same. So we're done with this portion of the transaction. So this is pretty familiar. This is just a wealth generating activity. We can see, right? Okay, one thing to remember, the price is the amount that the business charges to the customer. So the price value is used in the sales portion of the 2 transactions we're going to be doing right now. The price goes to the revenue account. Okay, let's look at the other half of what's going on here. So TLC also used up inventory. Since TLC sold inventory, it doesn't have the physical inventory anymore, right? So this means the inventory account must be reduced. So here's my inventory account. Remember, the $900 is the cost. So we are going to reduce the cost of what they sold. So obviously they didn't sell all of the inventory they purchased, right? They sold inventory only costing $200. So I'm going to reduce my inventory account by $200. Okay, that makes sense. By giving up this inventory, TLC is consuming wealth, right? So that means that my retained earnings is going to be reduced. All right, so if I look at my balance sheet equation, assets went down by 200, equity claims went down by 200, and I'm balanced. Retained earnings changed again, so we analyzed to see whether this needs to be reflected in the income statement, and yes, it does. Since TLC consumed wealth, used up the inventory, the income statement is impacted. Remember that using up assets is one of the definitions of an expense, right? And the specific expense account when selling inventory assets is cost of goods sold. So my expense called cost of goods sold is going to go up, remember, because we're increasing our expenses. Expenses go up, that means my net income goes down. My net income and my retained earnings have changed by the same amount, so we are done. Okay, just looking at the income, the net income column, we can see that our company earned a gross profit of $300. Sales revenue of $500 minus cost of goods sold of $200 means they have a gross profit of $300. And you'll notice that the company's internally generated equity claims has likewise increased by the $300 gross profit amount. That should make sense. Okay. So here's a look at Under Armour's income statement. Since Under Armour buys inventory, like athletic shoes, athletic wear, etc., and then sells that inventory to customers, they're a product-based business. Notice that the top of the income statement, the first two headings are net revenue, so they don't use sales, they use revenue as their name, and then cost of goods sold. And these are those two accounts that we just learned about, and they relate to one another. So the price that Under Armour charged to its customers for all of its inventory sales in 2020 is $4.4 billion. So this right here. The cost of the inventory it sold in 2020 was $2.3 billion. All right, so Under Armour made a gross profit from buying and selling inventory of about $2.1 billion. Okay, so that's a look at what an actual financial statement. They've done these transactions that we just participated in. That's what it looks like in the financial statements. Okay, one more. So this is the asset portion of Under Armour's balance sheet. Notice that one of the assets listed is inventory. So that's the asset that they buy specifically to sell. So the cost, this is the cost. So $895 is the cost of the inventory that Under Armour has purchased, but had not sold yet by December. See, this is December 2020. This account relates very closely to the income statement, sales, and cost of goods sold account. And hopefully you can understand how those all fit together now. So this is the end of our product-based transaction lesson. You're ready to go ahead and take the quiz. Good luck.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.